Thank you everyone for joining us today for our Upside Avenue educational webinar series. This series is developed with your input, actually. We surveyed our investors and followers to find out what financial and investment topics everyone is interested in learning about. And then we looked for subject matter experts all over the country who can speak on these topics in hopes of providing you with the knowledge and confidence to manage your finances and make better informed investment decisions. We want to make sure you're living your upside. So watch your email for information about February's webinar, and we'll also share it on Facebook, Twitter, and LinkedIn. So today we have not one, but two energetic and incredibly knowledgeable guest speakers from Financial Management Network. Both Jeff and Joe are certified financial planners based out of California. Jeff has been recognized by American Equity Investment Insurance Company as a top 1.5% advisor, and he is also an avid attendee of Ed Slott's individual retirement account training seminars. Jeff was featured on the front page of the Daily Press and continues to give back to schools as an assistant golf coach at San Juan Hills High School. Joe was the first to advance from FMN's rigorous mentoring program and says that nothing is more rewarding than to see his clients succeed in improving their quality of life and accomplishing their financial goals. When he's not building long-lasting relationships with his clients, he's spending time with his wife, 2 sons, and their dog Taz, being active and traveling. So without further ado, please give a warm welcome to our friends from Financial Management Network, Jeff Stanga and Joe Cavallo.
Thanks a lot, Jessica. We appreciate your time and thank you for joining us today. As Jessica pointed out, we're going to be going over really what happened in the year of 2019. It was an absolute banner year in the stock market. So everything we discussed today is going to be geared around the United States stock market, international markets, and the fixed income or bond markets. Please, if you guys have any questions, like Jessica said, use that chat area. And if you have it, we will take questions at the end. So please write those down, use them in the chat, and we'll certainly get to those. We'll be talking about the headwinds of the market, things that we think could possibly derail the continued growth in the market. And then we'll also cover the tailwinds of the market, things that are going to really possibly boost or continue to have this growth that we've seen over the past decade through 2020, 2021, and beyond. As an overview of 2019, at the end of 2018, actually, mortgage rates had climbed up near 5%. This was a huge increase because the Federal Reserve decided that they were going to raise interest rates in 2018. As some of you may know, in the latter part of 2018, specifically the fourth quarter, October, November, and December, we had one of the worst stock market declines since 1931. The market went down nearly 23% in that time. The Fed, when they noticed that their third rate cut really dampened the markets, they did an about face. They reversed course, and come 2019, they actually cut rates 3 times, which led to one of the largest stock market gains across the board since 2013. What also really added to the firepower behind 2019 was having the lowest unemployment rate in the past 40 years. That, coupled with the Tax Cuts and Jobs Act, really showed that 2019, between U.S. equities and international equities and short-term treasuries, even commodities, there was just a lot of participation in this bull market across the board. In front of us, we have this wonderful chart that shows us between the total U.S. market being up almost 31%, international being up 22 almost %, and then you have your real estate market, REITs, up nearly 30%. Bonds, they participated as well, being positive, up 8.5% across the board. So again, the theme for 2019 was risk was on, interest rates were down, and the markets flew to new highs. And we're continuing to see that already in 2020. You know, January is off to a banner year. We're continuing to hit all-time highs. And so the question that we start to ask ourselves is, how long can this rally last? We've sat here for the past decade plus now, since March of 2009, which is when we had the low, and we had that low at 677 on the S&P 500, and we're sitting here near 3,300 today, almost 400% return in the overall US stock market. Here's a chart of the last 20 years of the US stock market. Again, we see a lot of that volatility that occurred in 2008, where it shot down nearly 56%. And since then, it's been nearly an uninterrupted straight line up to 3,300 on the S&P 500. What was the big catalyst to the last decade of huge returns? Global monetary policy easing. Said in layman's terms, don't fight the Fed. The Fed lowers interest rates, buy equities. The Fed wants to be bullish in their purchasing of bonds, buy equities. So equities have been a huge area for gains and growth over the past decade. There hasn't been a single asset class, whether it's real estate or commodities or bonds or international stocks, that have shown such a precipitous rise over US large company stocks. So we've seen this huge run. Now, you know, again, what added to that run that we see now and is this unemployment rate. It's now below 4%. And when you have unemployment this low, it really shows you that the business cycle and the companies are really looking to continue their hiring, continue to attempt to expand, or at least keep doing what they're doing. Moving though into these headwinds is something that I think will really help all of you out there listening to say, hey, well, what's going on? Can we continue this precipitous rise in the stock market? And so one of the big things that we saw that occurred late last year was this China trade deal, or I should say phase one of the China trade deal. Right now, China has agreed to buy $200 billion of our US goods. And for that, we're saying, okay, great, we're going to cut tariffs on 120 billion of Chinese goods. There's still a lot of information that has not been disclosed on China's trade phase one. Not sure if it's something that truly is going to help, but it is a step in the right direction, especially as we enter this election year. Will we continue to see more China trade phase two deals before the election, after the election? These are all things that are to be determined, but it is at least saying, okay, we're at the table and we're trying to have the conversations about how can we work better with China instead of just importing a bunch of their goods. Another big headwind that we see is the business cycle. Since we've had that expansion since 2009, we noticed that when you have an 11-year growth cycle, you need to start to typically see some recession or some pullback or some slowing in the economy. So this is a great chart to say, where are all the countries across the board? And you'll notice that a lot of the large companies, US, France, Japan, South Korea, those are all in the late expansionary or late economic growth cycle. Now, to be fair, there's not always a chronological or linear progression among these phases. There have been cycles where the economy has skipped a phase or retraced an earlier one. And retracing an earlier one would be looking at 2015 and 16. As markets started to sputter, we saw global economic monetary policy across the globe start to ease again. The Bank of Japan cut their interest rates. Germany cut their interest rates, which again furthered expansion for another 3 to 4 years. So now we sit here, late business cycle. We're not saying that there has to be a contraction or that there has to be a recession, but those things are typically followed by 10 years of recovery and expansion like we've seen. One of the things that gets a lot of the headlines, though, has been this geopolitical climate, the U.S. and Iran conflict. As most of you have known, the U.S. killed Qasem Soleimani on January 3rd, and then Iran attempted to retaliate, or they did retaliate, with some non-lethal missile strikes against 2 of our U.S. facilities. Now, the situation does appear to have been de-escalated. However, investors I know are continuing to worry about the potential for this conflict. So while we don't believe that a war is likely at this point, what we do know is that if you want to see if there's going to be some real conflict, watch the price of petroleum. Oil prices are going to tell you the truth. Is there tension in the Middle East? If so, you're going to see that reflected in the price of oil going up to 70, 80, 90. So these are all interesting headwinds that we feel are going to really possibly create some volatility for 2020 and 2021.
So this next slide here, this is Joe, by the way. Thank you guys for your time. Really appreciate it. Clients come in all the time and they say, with new cash, why invest in the stock market? It seems like it's at all-time highs right now. And it is expensive out there, but I wanted to show this chart to say, how is it compared to the last 25 years? What this is saying is these companies, on average, over the last 25 years, have traded at a 16 times multiple of their earnings. If you look back in 99, 2000, 2001, during the dot-com bubble, they were trading north of 24%, as you can see in the chart here. Today, they're trading right around 18 times, which historically is higher. But I'm going to talk about a couple of reasons why I think that could go higher. And one of those is technology, and there's a couple of other reasons I'm going to touch on it in a bit here. But overall, we think it is expensive out there, but there is some definite room for growth. And we're optimistic, we're bullish on the stock market for definitely this year.
Thanks, Joe. That's great. So getting back to Joe's bullishness, and this is interesting because the flattening of the yield curve, I know, big economic term there, flattening of the yield curve. Basically, what does that mean? The short end of the curve, if you lend or borrow money in a 3-month, 1-year, 2-year period, you're getting nearly the same rate of return as you are if you're lending the government money for 30 years. This chart, the blue line, shows you lend money to the government, U.S. government, for 30 years, they're going to pay you 2.39%. You lend them government money for 2 years, you're going to get 1.58%. Not a huge spread there when compared to the dotted dashed gray line of December 31st, 2013 that shows, wow, 2-year rates were up 0.13 and you had almost a 3.8% difference if you lent over 30 years. The gray line is what a typical yield curve looks like. Maybe some of you have read about the flattening of the yield curve and that, oh, this is a sign of recession. We're here to tell you that the current environment is extremely unique. It's easy to see what's going on in the front half of that curve. That's the part that the Federal Reserve controls, so they can monkey with short-term interest rates. The long end of the curve, though, that's what investors' expectation controls. That's what the market sentiment controls. That's what inflation expectations control. And so many market watchers interpret this flattening of the yield curve as a signal that winter is coming for the bull market. That's for all you Game of Thrones advocates out there. Winter is coming for this bull market. But not so fast, though, because in the wake of this historic zero interest rate policy, when you look at global rates across the board, this slide here shows you that the United States currently on a 10-year bond, so you give your money to the U.S. government, they say, we're going to give you 1.79% per year over 10 years. When you compare this against all the other large countries out there across the globe, Germany, for example, you give Germany $10,000, they tell you, hey, we'll hold it for you, and we're going to give you less back in 10 years. So across the board, you have low interest rates. When you have low interest rates across the board and you're a retired individual or you're somebody that needs cash flow, you have to look elsewhere for yield. And where do people look? They look to the stock market. They look to real estate. They look to other cash producing assets. And that's where when Joe mentions that he's bullish and we're bullish on the stock market, it's simply because when you have low global interest rates, you have to go somewhere else for yield because inflation is not going to stop or pause. Things are still going up at the rate of 2.9 to 3.3% annually. So Joe, you want to get into some of your awesome tailwinds in the market here?
Yes, a little more exciting news for more of a bullish look in the market, which is what we feel we're headed into. And the reason being is inflation remains dormant and interest rates remain low. 2018 in October, the Fed came out and they said, we're going to start raising rates. And as a result, the market corrected. It took a nosedive in October. November, there was no news. December, they actually raised the rates. On December 26th, the Fed came out, they put their hand up, they said, our bad, we shouldn't have done that. And what we received at that point in time was really important, was transparency. The Fed actually said, we're going to stay out of the picture. We're not going to raise rates. If anything, we're going to lower rates. And they proceeded to lower rates 3 times in 2019. And we think that that's going to be the trend moving forward. Inflation should remain dormant, primarily in my view because of technology, which I'll get into in a second here, but interest rates should remain low as well. It does not pay to be safe, and it's going to continue to be tough to make money in a safe environment. So there's going to be more money funneling towards equities. I'm very excited about this technology revolution that we're headed into. This chart really tells a story. If you look right in the middle of the chart in 2001, $1,000 worth of computation bought the same equivalency of one insect brain. And if you go up to 2023, $1,000 of computation buys one human brain. Stretch all the way out to 2050, the prediction is that $1,000 worth of computation will equal all human brains. What this tells me is that technology is getting bigger, badder, smarter, and most of all, cheaper. And that we think is going to really push this economy forward for the next decade, in my opinion. In touching on technology, there's 3 main areas that I wanted to hit on. And I'll start from the right on this chart here, from the right to the left. So, and the reason why I want to start to the right is consumerism is the #1 driver of the economy. It accounts for 70% of the dollars being infused into the economy. And to start with, you have e-commerce. E-commerce is going to be Amazon. It's going to be you go online, you can swipe your finger and buy something. It's just becoming easier to purchase things. We think that that's going to get even easier, even more efficient as the years go on. Social networks is huge. Social networks, social media, marketing. I follow Dwayne Johnson on Instagram. He's coming out with a tequila in like a month or 2. I'm going to buy that tequila. It's just because Dwayne Johnson did it, I'm going to buy it. That's kind of where we're headed in this social environment. And you're starting to see companies take advantage of that too with their marketing over these social medias. Hierarchies, people are needy. Generally, people are needy. They want to improve their lives, and they're going to do what it takes to improve their lives. And because of technology, they're able to do that in a much quicker, much more efficient way. Biotechnology, drugs are becoming more advanced, vastly better for people. And you're starting to see people living longer as a result. Medical devices are becoming way less intrusive. You've got diseases like type 1 diabetics. My wife has type 1 diabetes, and she actually is using a product called Dexcom to monitor her sugar levels, and it just makes it so much easier for her and less evasive. She doesn't have to prick herself with a needle 3 times a day anymore. Diagnostics, we're becoming more smarter on as far as testing and preventative things for people so they can stay healthier. That's just going to drive more money into that environment. And then just on the tech revolution in and of itself, you got these processing machines, food processing machines are becoming bigger, badder, more efficient. Software, you've got companies like I'm drawing a blank on the name of the company. I apologize, but it's the database, the storage, the cloud-based systems for these companies that are making these companies much more efficient, easier to transfer data between, easier to store data, much more data. Artificial intelligence, it's kind of we're getting to a point where computers and machines are doing jobs for people. I'm not going to get into where that's going to take us 50 years from now, which I'm not too optimistic about. But over the next 10 years, I think that's only going to improve this economy. The other big piece that I feel why this economy over the next 10 years could really boom and continue to do well is because of the demographics and this growing population, as we call the millennials. The millennials they're delayed. They like to enjoy life. They, as my friend to my left of me right now, Jeff, calls them craft beer drinking generation. So,
yeah, don't those millennials like to just drink craft beer and play on their iPhones and like tiny houses, Joe?
they can continue to do that, have fun, but they're also going to help drive this economy too. So in this chart, what we're seeing is a low in this key home buying demographic, but it's poised to just boost from here. And I believe that because these millennials are becoming in their 30s, they're starting to make money. There's a lot of dual working spouses that are making more money. They're going to borrow money to buy these homes. And I really think that's going to push this real estate market forward too. So in sum, as a result of the low interest rate environment, inflation being dormant, and this technology revolution, which is, in my opinion, way different than the dot-com bubble, we are headed for higher prices, and I'm bullish on this market. So that's going to conclude our talking points here. We're going to open it up for Q&A.
So what questions do you have from us here?
Hey, so while people are typing in their questions, Jeff and Joe, I was wondering, what can you tell us about the outlook for multifamily investors for 2020? Our Upside Avenue investors, obviously, through investing in Upside Avenue, have a hand in the multifamily industry. What are your thoughts on that for 2020?
Thanks, Jessica. As a disclaimer, we are certified financial planners, so we aren't paid to say, hey, multifamily is awesome, everybody get into it. So here's our economic outlook on that, though. For as we look at it, we like multifamily. We like multifamily because it gives these younger millennial investors a way to get into some type of place to live because they like the community, they like the smaller spaces. Multifamily is a great space, especially because a lot of those square footages range between 650 to 1,400 square feet, and that's the type of living that we're seeing a lot of these millennial couples gravitate towards. And so while prices are high for single family residences across the country, we're really seeing a lot of traction in multifamily space because, again, millennials are some of the most, I would say, conscious when it comes to their effect on the environment. And one of the big things that they do is look for ways to have housing, but not have 3,000, 4,000, 5,000 square feet. So in short, we really do love multifamily. We think it's a great area to invest in, and we think it will continue to grow.
Thanks for that. And I think millennials too, they're quite mobile too. They love to travel. I'm sure they don't want to be anchored to a large house and have all the upkeep that goes with home ownership.
Well, not even just the millennials as well. I mean, you have the older generation as well. These boomers that are looking for a more simplified life as well. And you're really starting to see, as far as like multi-tenant type of property, you're starting to see these multi-living facilities that are kind of all inclusive, where someone who's 55 and older can go and hang out with people who their peers, and they can have everything in this one building, and just enjoy life. And I think that's gonna be a popular area as well, which in a way is that multi-tenant type of arrangement.
It's so true. It's so true. So for our investors then, how should they start investing moving forward?
We're there's a lot of different ways to invest money. It really is, and you kind of look at different areas. We've touched on a few places here today with where the stock market's at. Stock market tends to be an uncomfortable place for some people, just because there's really not a lot of control there. But it's proven to be a performer over time. We as we mentioned are bullish on that, but at the same time, we're not saying take all of your money and throw it in there. We firmly believe in diversification, and part of that piece is real estate. Real estate we really are high on. We think it's a great income source for our clients, so we use that as a piece of the pie that when we're investing money. And there's several other alternative type of investments out there as well that are just different, unique. But our whole goal with money and managing, and we're making recommendations, is to be diversified. As cliche as that sound, it is important, and it's proven. It's a proven method to invest money.
And what is diversification, Joe? Diversification in our mind, hey, if you have 50% of your money in the market, make sure it's split between U.S. large company stocks like Visa, Costco, Amazon, Apple, mid-company stocks, small company stocks, international stocks, emerging market stocks. When you have a vast majority of diversified stocks across the globe, you really lower the risk in your portfolio. So if half your money's in equities, there you go, diversify it. The other half of your money is in bonds, real estate, commodities, things like that. You start to really fill out a portfolio, Jessica. And so one thing that we can offer a lot of the individuals that are on here is if they want us to take a look at what they've got, they want to have a quick consultation, email us.
Okay. Next year's an election year too. Any thoughts on that and how to invest in an election year?
It's kind of been an interesting election and geopolitical environment, hasn't it? It's something we haven't, in my lifetime, I haven't followed politics too much in my earlier years, but based on when I was in school, I don't remember a political environment like we're experiencing right now. And that certainly is a risk. It really is. When I said I'm bullish on the market, it really is contingent on things occurring in a healthy political environment, and this economy continuing to extend and move forward. So it's we're kind of looking at it as a wait and see approach, but at the same time, if your money is spread out and you're diversified, but you're committed to a long term, 1 year of an election should not have an impact. Historically, and I'm sure my buddy Jeff here has got some stats on this. He's the stat guy. But historically, election years have done well for the markets. You usually don't want to make too much noise to cause any sort of rift in the markets and lose voters. But we're optimistic that this is going to be a good year in the market, and that you should continue to ride this bull wave that is going to keep marching forward.
Yeah, know what you own, Jessica. Know what you own. So if you're going to be an investor in an election year, if you own Disney, you own Visa, you own Costco, you own MasterCard, are these things really going to be impacted by a change or no change in an election cycle? No. So know what you own.
Perfect. Thanks, guys. Any other questions from our participants and our attendees today? Let's see here. Okay. Any final comments from you, Jeff and Joe, before we
I would say one final comment that we see is, again, 2020 seems to be a continuation of 2019. But at the same time, you want to look beyond just 2020. For those of you who are listening to this, you're typically, we see people who are listening to this between the ages of 35 and 75. And when we see people that in that age group, you need to be more of a long-term investor. So it's hard to be a long-term investor, though, with a short-sighted mindset. So don't just worry about the election year, but look at your overall portfolio for the long term.
Perfect. Thank you so much for the wealth of information on the state of the market, guys.
Jessica, it looks like we do have some questions here.
Oh, perfect. So the question is, when do they see a slowdown post 2020?
Yeah. So when do we see a slowdown post 2020? As long as we continue to see monetary policy easing across the board, a slowdown is definitely in the cards, probably around mid 2021. We say that because, yes, while we have low unemployment rate, you'll also have this economic situation arise called the next dollar. How much work are you getting for that next dollar? So what has to happen here is, as unemployment stays low, if you need to hire, you need to pay somebody more money. But typically that next hire, since they're not in work, is not going to produce the same goods or the same output as your continued staff. And so what happens is you start to see inflation pick up probably around 2021. So good question, Ritesh. We like that question, but yeah, I would say 2021 is when you start to mid 2021 is when we'll start to see a slowdown.
Perfect. Anyone else have any questions while we have Jeff and Joe on the line? What do you expect to happen to the economy if Trump is removed from the office?
A common question. We get that all the time. It's tough to say. It really is. If you look at both parties historically, there's evidence that the markets have done well in both types of environments. Certainly, we believe that the economy has definitely prospered over these last 3 years. How much of that is attributed to tax reform and such is it's really just tough to say. So, our take is to not be extreme on one way or the other. I can give you an example with a client of mine. Back in 2016, when Trump was elected, she emailed me and said, "I need to meet with you." And I met with her. She sat down with me. She was nearly crying. And she said, "I want you to manage my money as if we're going to war." And I tried to talk her out of it. I tried to calm her down, but it was an extreme situation. It's her money. Ultimately, it was her decision as much as I tried to talk her off the ledge there. And she missed out on all of 2017, which we saw was a great year in the market. So my point to that is extreme measures can get you hurt. It can really get you hurt in one way or the other. That's why we say if you believe in the long term, if you believe in capitalism, if you believe in what drives the economy, which is companies and consumers, as long as companies make money and consumers spend money to make these companies money, then I think we're going to be okay. Either way.
Yeah, Anna, I do second what Joe said there. And I understand, for those of you who are still listening in on this, the Tax Cuts and Jobs Act does not go away until 2025. So if Trump's removed from office, Trump is not in office come the election, understand that those tax cuts that are a huge boon to all of these United States companies, that's in effect until 2025, people.
Perfect. These are all great questions, everyone. Okay.
Yeah, thank you everyone for your time. We really appreciate it, and the opportunity to speak with you today. We'll if you guys have other questions, Jessica, you could forward them to us via email if you'd like, and we'll get back to the listeners as quickly as we can.
Absolutely. Thank you guys for the wealth of information. We hope that everyone will join us for another Upside Avenue educational webinar. We surveyed all of you, our investors and followers, to find out what financial and investment topics everyone is most interested in learning about. And then we look for subject matter experts like Jeff and Joe who can speak on these topics. So look out for the registration information for February's webinar in your email. and we'll also share it on our Facebook, Twitter, and LinkedIn. In the meantime, if you do want to contact Jeff or Joe directly, here is their contact information. We ask you to start living your upside with Upside Avenue. We provide access to a professionally managed, diversified portfolio of income-producing multifamily real estate for as little as $2,000. You can visit our website, upsideavenue.com, or send us an email or call us if you have any questions. Thanks again for joining us, Jeff and Joe. Thank you again, and I hope everyone has a wonderful day.
Our pleasure. Thank you.
Thank you.